Welcome everyone to the White Cloud YouTube channel. This month we're going to be talking about Treasury Bonds, how they work, and how you can use them as an investment in your portfolio. We're also going to be talking about the current state of the market and the bubble that we feel like we're in. To borrow one of the terms or sentences from one of the research companies we use, it's very hard to find a good stock at a fair price in today's market.
And one of the things that a famous economist taught us, John Kenneth Galbraith, he said that one of the things we focus on with bubbles is what caused the crash. And that's where the most emphasis is places in that question. But what we really should be focused on is what's caused the actual bubble. So we look at past bubbles. The dot-com bubble that happened in the late 90s, early 2000 era, and then the mortgage bubble of 2008. Those were both caused by different things. Is the tech boom of the 90s, and then mortgages getting sold to anybody who could fog a mirror in the mid 2000s. Those bubbles started to show in 1998, so about 2 years before it actually popped, and the other mortgage bubbles started to show in 2005 before it actually popped. Focusing on that's kind of the way you can actually see one coming, and that's where our emphasis should be placed.
So Sean, in today's market, where would you say, or what would you say is causing the bubble in our financial market today?
So like over the last 12 years or so, the Federal Reserve has done a lot of what we call quantitative easing. That's where they print our own money and purchase our own bonds, and what it does is it causes money to become easy. It becomes easy to borrow. It typically drives interest rates lower, and puts all that money on the bank's balance sheets. Doesn't necessarily mean that it's going to flow out into the economy, but it does control where interest rates have typically gone, and it's kind of a new methodology, something new that they've started to do. And I would say when we look back in the history books 20, 30 years from now, everybody's going to look at the Feds and say they created that bubble.
Okay. And then jumping into Treasury Bonds, let's talk a little bit about what they are and how they work. So a Treasury Bond is a debt issued backed by the United States government, and you can get anywhere from a short-term bond that's 6 months to a year to 5, 10, 20, even 30-year or long duration bonds. And Sean, do you want to dive into a little bit of how they work and how you might use them in a portfolio?
Yeah, so you can make money in bonds, in Treasury bonds in two ways. First one is through its coupon rate. So typically, that rate's in recent years, back in the early 2000s, it was around like 6%, and today it's around 2% on a long-term Treasury. So if you have a $10,000 invested in a bond for 30 years, you're going to get your $10,000 back 30 years from now. But in the meantime, every single year, you're going to get paid on that 2%, $200 on the $10,000. So that's the first way you make money. The second way you make money is if the actual interest rates go down, then the value of your bond goes up in the short run. So bonds values can change, and it just all depends on what happens with interest rates. So for example, since March of this year, bond rates went up to 2.45%, and since March until now they've come down. They've been hovering around 1.8 to 1.9% over the last few weeks. So that's a little over a 0.5% move in the interest rates there. And so if you were holding bonds back in March until now, you made somewhere between 8 and 12% depending on the day that you bought it in that month. And it's a great way to make a good chunk of change.
Yeah, and so just to recap, so when the interest rate falls, the price that you pay for the bond goes up, and that's where you get your appreciation or your gain. Is that right?
Yeah, in the short run, yep.
Mm-hmm. And then looking at the different types of bonds, we've got 1-year bonds, 5-year bonds, all the way up to 30-year bonds. Can you explain kind of the diving board analogy as far as like which ones do what when?
Yeah, so shorter term bonds, if just like on the diving board, they would have less swing in their price. So if you buy a 30-year bond, which is the longest ones you can get, they're going to have a bigger swing in their price depending on what's happening with interest rates. So if interest rates actually go up, you're going to lose a lot of money if you're in the 30-year bond versus the 2-year bond. So, and you don't necessarily lose that money unless you sell it, but the price or the value of your bond is going to change.
Okay.
So as far as how that relates to bubbles, Dave, tell us what happened with Treasury bonds during the 2000 and 2008 years.
Yeah, so in those years, what you saw was, and I don't have the exact percentages in front of me, but what you saw was an interest rate environment in the Treasury bond space that went from say a 4% down to maybe 2.5%. So you had a 1.5% decline in the interest rate, and part of the reason is because when the euphoria of a market crash starts to subside and you see large sell-offs, Treasury bonds have historically been what you'd call a safe haven. So everybody runs to them, and then that's gonna, of course, create the demand for those. And so that's where you see just significant price appreciation during times of a big market correction where equities are selling off.
Right. So if in today's environment, if we went from a 2% down to 1% on the 30-year Treasury, you're gonna have a big upswing in your price from somewhere between 25 and 50%, depending on how far those interest rates go down. So Dave, back to financial bubbles and that original question of what causes them to crash. We talked about what causes bubbles to happen and how you can see them and what we've seen in historical bubbles. But what potentially could cause a bubble to pop?
Yeah, so I guess any number of things can really cause a bubble to crash. Ultimately, it's really when the euphoria wears off and investors start to either get worried or they just think, hey, that's been a good run, we're out of here. Much like getting invited to your friends, your best friend's barbecue, and he cooks the best food. You're excited to go. You got some euphoria because you're gonna get some great food and hang out with some people that you like, and so you go and then you have a great time. But after a few hours and a few ribs later, you're tired and you're ready to go, so you leave. That's my take on it anyway.
Awesome. So the thing we've talked about today is bonds and how Treasury bonds have worked in past bubbles. You should consult your financial advisor in your particular case. Dave and I don't necessarily like Treasury bonds for the long term. As an investment, they've typically underperformed stocks and real estate, but we do think they make sense in certain situations. And so again, you should consult your financial advisor in your particular case. Thank you for joining us this month. We'll look forward to giving you some more information next time.